The global financial system operates on a foundation of faith. Faith in fiat currencies, faith in central banks, and faith in the perpetual stability of an economic order that has remained fundamentally unchanged since President Richard Nixon severed the final link between the US dollar and gold in 1971. This system of unbacked paper money has enabled unprecedented government spending, massive credit expansion, and decades of economic growth. But it has also created a world of towering debt, speculative excess, and chronic inflation. According to multiple reports from insiders within Trump-aligned think tanks and policy circles, there is a bold and revolutionary plan being developed for a potential second Trump administration. The phased return of the United States to a gold standard with a target implementation date of 2027. This is not merely a fringe idea, but a serious proposal being debated as a strategic response to what its proponents see as the inevitable collapse of the current fiat dollar system. The plan, often referred to internally as the 2027 reset, aims to restore discipline, stability, and long-term value to the American currency, but it would also represent the most profound and disruptive reorganization of the global financial architecture in over half a century. The intellectual groundwork for this policy is being laid by a network of conservative economists, sound money advocates, and former officials who argue that the current fiat system is inherently unstable and headed for a crisis. Their case begins with a simple and powerful observation. Since the dollar was fully untethered from gold, its purchasing power has collapsed. $1 from 1971 is worth less than 15 cents today. This erosion of value, they contend, is a hidden tax on savers and a primary driver of wealth inequality. Furthermore, the ability to create money without constraint has enabled the federal government to accumulate a national debt that exceeds $34 trillion, a sum that is now growing at an exponential rate. The proponents of a gold standard argue that it would act as a straitjacket on fiscal and monetary policy, forcing the government to live within its means and stripping the Federal Reserve of its power to create endless liquidity and fuel destructive boom and bust cycles. The plan is not envisioned as a sudden overnight return to a classical gold standard, where every dollar in circulation is backed by a corresponding amount of gold in a vault. Such a move would be practically impossible given the current money supply. Instead, the proposed 2027 reset is a more nuanced and multi-stage strategy designed to re-anchor the dollar to gold over a transitional period. The first phase of the plan, which could begin as early as 2025 if the political conditions are right, would involve a public and presidential commitment to the principle of sound money. This would include executive orders directing the Treasury Department to study the practical steps for a return to gold convertibility and the introduction of legislation to define a new gold-linked legal tender. Simultaneously, the administration would likely pursue a public relations campaign to educate citizens on the dangers of fiat currency and the historical benefits of a gold-backed system. The second, and most critical phase, would involve a comprehensive audit of the nation's gold reserves. There has long been speculation and concern about the precise status and whereabouts of America's official gold holdings, much of which is stored at Fort Knox and the Federal Reserve Bank of New York. A transparent and verifiable audit would be essential to establish credibility for the new system. Following this, the Treasury would announce a fixed but non-convertible gold price for the dollar. This would not yet mean that citizens could walk into a bank and exchange their dollars for gold coins, but it would establish an official valuation that would guide monetary policy. The operational heart of the reset would be the reestablishment of a modified form of gold convertibility, but primarily for international transactions. Under this proposed system, foreign central banks and international financial institutions would be able to convert their dollar reserves into gold at the fixed price. This would immediately restore discipline to U.S. monetary policy, as the Federal Reserve could no longer engage in quantitative easing or rampant money printing without triggering a run on America's gold reserves. The value of the dollar would once again be tied to something real, tangible, and limited. The global supply of gold, which grows at a slow and predictable rate of roughly 1% to 2% per year. For domestic citizens, the plan might involve the issuance of new gold-backed savings bonds or the promotion of existing gold and silver coins, like the American Eagle series, as official alternatives to fiat currency for long-term savings. The ultimate goal would be to create a parallel system where a gold-backed dollar circulates alongside and eventually supplants the current fiat dollar, restoring confidence in the currency's long-term store of value. The motivations behind this radical plan are a mixture of economic ideology, geopolitical strategy, and political calculation. On an ideological level, it represents the culmination of a long-held conservative dream to end the era of big government funded by an endless stream of fiat money. It is a direct embodiment of the Austrian School of Economics, which views the manipulation of money and credit by central banks as the primary cause of economic cycles. By returning to gold, proponents believe they can eliminate inflation, curb government excess, and re-establish a truly free market monetary system. On a geopolitical level, the move is seen as a masterstroke to reinforce the US dollar's status as the world's reserve currency at a time when it faces unprecedented challenges. Nations like China and Russia, along with the BRICS coalition, are actively seeking ways to dethrone the dollar. A gold-backed dollar would be vastly more difficult to challenge than the current fiat version, instantly making it the hardest and most reliable currency in the world. It would force other nations to either follow suit or risk seeing their own fiat currencies depreciate against the sound money of the United States. However, the transition would be fraught with immense risk and would likely trigger severe short-term economic turbulence. The immediate and most dramatic consequence would be a period of crushing deflation. By fixing the dollar to gold, the money supply would become constrained, likely causing a sharp contraction in credit and a dramatic fall in asset prices, from stocks and bonds to real estate. The initial shock could trigger a depression deeper than that of the 1930s. As the economy adjusted to a new regime of hard money and fiscal discipline, interest rates would skyrocket as the government competed for a limited pool of real savings to finance its debt, potentially making the current debt burden unsustainable and forcing a massive and painful fiscal adjustment through spending cuts and tax increases. The banking system, which is built on the foundation of fractional reserve lending and a plentiful supply of fiat money, would face an existential crisis. A gold standard removes the central bank's ability to act as a lender of last resort during a panic, making bank runs a real and terrifying possibility. The entire structure of modern finance, from complex derivatives to high-frequency trading, is predicated on a system of elastic money. A gold standard would fundamentally break that model. The global repercussions would be equally seismic. Countries that hold massive dollar reserves, such as China and Japan, would see a dramatic revaluation of their assets. If they believed in the long-term credibility of the new gold-backed dollar, they might hold on. If they feared the U.S. would be forced to devalue or abandon the peg, they might rush to convert their dollars into gold, precipitating an international crisis. Global trade would be disrupted as exchange rates gyrated violently, and commodity prices would experience wild fluctuations before settling into a new equilibrium. The plan's success would hinge entirely on the credibility and permanence of the U.S. government's commitment. Any perception that the government might devalue the dollar against gold or abandon the standard in the face of political pressure would lead to speculative attacks that could drain the Treasury's reserves and destroy the system's credibility. The history of the gold standard is littered with examples of countries being forced to suspend convertibility during times of war or economic stress. The question is whether modern America has the political will to endure the immense short-term pain for the promised long-term gain. In conclusion, the discussion of a Trump-led return to the gold standard in 2027 is far more than a political soundbite or a nostalgic fantasy. It is a serious, if highly controversial policy proposition that emerges from a deep-seated critique of the current financial order and a profound fear of its impending collapse. It represents a fundamental choice between two opposing visions of money, one of state-managed, elastic fiat currency designed to facilitate growth and state power, and another of apolitical, disciplined, hard money designed to preserve value and individual liberty. The 2027 reset would be a gamble of historic proportions, an attempt to preemptively solve a looming debt and currency crisis by voluntarily imposing a discipline that the market would otherwise eventually impose through a chaotic and destructive collapse. Its advocates see it as the only way to secure America's financial future and global leadership for the next century. Its detractors see it as a recipe for a deflationary depression that would cripple the economy and cause untold social hardship. Whether this plan moves from policy paper to reality will depend on the political winds of the coming years, but its very existence signals a growing recognition that the age of effortless fiat money may be entering its final tumultuous chapter.